Good morning and welcome to the Future of Advice webinar. I'm Tom Nuttall, Workplace Solutions Director at SimplyBiz Group. Today's focus is pensions, and I'm joined by a fantastic panel of guests. David Cooper, GRP Group. Steve Webb, Royal London's Director of Policy and External Communications. Andrew Tully, Retirement Advantage Pensions Technical Director. And of course Richard Nuttall, Head of Compliance at SimplyBiz Group. Okay, again, this session is driven by you, so thank you for those of you that have dropped in questions so far. You can drop in those questions live and we'll do our best to multitask and have the debate and also pick up those questions and answer them directly. So the more questions that you drop through, the more you can drive this and personalise the content of this hour. Today is a big day, of course. It's a new week in politics and the economy and so on. We're going to stick to our present agenda, and you can guide us through the rest. So we're going to focus on retirement freedoms. A year down the line, look at how that's panned out and whether it's fit for purpose and how it's worked, and also look at some of the implications around changes, including lifetime ISA. And we know from the last webinar that there were a lot of questions on that topic. So first though, I'm just going to ask the panel to perhaps share some headlines of what's keeping you busy and certainly what's keeping you busy when it comes to supporting advisors and their clients. So David, please.
Yeah, thanks. I think there's been three priorities on my organisation's agenda in the recent months, so ignoring Friday. First and foremost, working with advisors and the wider industry to establish when we might see a new norm post-freedoms. And I guess you'll take from that comment that it's not there yet in our view. Secondly, looking forward, looking ahead to the secondary annuity market, preparations for that. And thirdly, somewhat parochially, completing our own merger of partnership and just retirement, which was only formalised 10, 11 weeks ago. So more work to be done on that.
Lots of change. Mm-hmm. We'll do creeping death. Hi, Steve. Just do it rather so yeah. So again, you've got quite a broad mandate at the moment. So what's keeping you busy?
I guess the interesting experience for me in the last 12 months has been moving from government to a provider, to Royal London, and I guess some of the things that I was involved in government weren't well received on the provider side, like the charge cap, for example. But two of the big reforms that I was involved in, auto enrolment and pension freedoms, have kept Royal London very busy. So, for example, this end of the provider market in terms of small and medium-sized firms were furiously busy. That seems to have been a niche where getting the right level of support for employers has been crucial. And then second, I guess, the at-retirement market drawdown has been a huge source of growth for us. Mm-hmm. And interestingly, we wondered whether the sort of personal pensions, the individual pensions market would fall off, and it hasn't really. Now, whether that's self-employed people cashing in before they thought tax relief was going to go, at every budget and every autumn statement. So there's certainly, plenty of positives. And I guess at the start of a week where it's tempted to be incredibly gloomy, actually the fact that millions more people are now saving for a pension is a huge step forward, and we've got to kind of build on that. Mm.
And we'll definitely touch on those themes throughout the next hour. So Andrew, yes, from a technical perspective, where are people throwing in the rocks?
I mean, I guess just building on what Steve said, from a positive theme, things have gone very well. People have adapted to pension freedom well, so it's been a very positive, generally, experience from that. We're seeing people very much wanting a combination of flexity, flexibility and certainty. It's a new word.
It's a new word right here.
So people absolutely love the flexibility, being able to take what they want, when they want, being able to cascade it on down to family, but building in a certainty that they have an income for life. So I guess the key for all of us is trying to help people do that in combination.
Excellent. And Richard, just thinking about the Biz Group membership and wider conversations, where are you seeing the most uncertainty perhaps still, or the most need for support, and where do you think actually now the market feels like it's perhaps clarified?
Well, certainly pensions is the thing where people need support on the technical knowledge. I think pensions freedom's kept everyone busy within the industry, and we've just run a series of events where we have whole days dedicated to pension freedoms, and you can see the level of knowledge that advisors have to have now. And even more recent than that, we've just rewritten, we've carried out an exercise where we've rewritten our suitability letters, and you can see now that this is no longer a product. this is a whole financial planning exercise, and the level to advise on these areas has increased so much more dramatically than it ever was in the past. And you know, it really is a financial planning exercise as opposed to simply just accessing pension freedoms going forward.
Yeah. And certainly a challenge if you're the consumer, the other side of that.
Well, it is. I mean, it's challenging for the providers, it's challenging for the advisors certainly, but you're right, it's challenging for consumers because of the level of information, but you know, they only know what they know. And I think it's only when you sometimes sit down with someone and go through the range of options, the alternatives, that you actually understand, you know, what a complex market it has now become.
Yeah. So to the panel and to the floor really, and of course to your questions. So given that we're just over a year now into pensions freedoms, would the panel consider that this reform has been a success? I might come to you last. So, Andrew,
yeah, I think in general terms it has. I think the majority of people seem to be acting fairly sensibly. So there was a worry that lots and lots of people would just take everything out all at one go, and that's not really envisaged. So that's not happened. So there's a bunch of people absolutely taking cash, but you could argue that they've done it for the right reasons in the right situation. We have seen a move towards drawdown, away from annuities to some degree. Interestingly, the last couple of quarters we've seen a little bit move back towards annuities. That could just be down to economic conditions, so I guess it'll be interesting to see where we go over the next few months. But people are using a balance of the two. So I think generally, yes, I think people have acted fairly sensibly. Certainly the feedback we get is customers do very much like what they've got. They like having control, they like having flexibility. So I think on a popularity side of things, absolutely people like it.
yeah, excellent. David, I mean, again, lots of change. You
Yeah,
said
I
11
mean, I
weeks
concur
in.
with pretty much all of that. I guess the one thing that we've been observing is that those consumers that go and get full advice absolutely get the right outcomes. However, a vast majority of people don't go and get full advice, as we're seeing. So only 1 in 5 people are using the guidance. And we're also seeing a growth in internally marketed annuities when compared with external, which can't have been the original intention nor indeed the regulators' ideal. So I think whilst I agree that the freedoms have absolutely raised awareness of pensions, which has been the real win in my mind. Some of the activities we're seeing, not quite beneath the surface, but second order aren't. I don't think what we want to see in the medium term. So that's probably my only comment.
And I guess we're looking at pensions freedoms from this vantage point. I guess how far further in the future do we need to stand to really judge whether it has been a success or not?
Well, certainly there was planning for the initial surge. You know, the April 2015 people who'd been, you know, hanging on desperately and wanted to go on bank holiday 6th of April kind of thing, and we're sort of working our way through that. And as Andrew says, I think we haven't kind of got to the new settled state yet. It's a genie that's got out of the bottle. I can't see anybody now saying, you know, vote for me and I'll stop you pension freedoming. That doesn't seem like it's going to happen. You could see tweaks and refinements. I mean, as David said, you know, the guidance stuff. I mean, what we don't know is how many people go to the PensionWise website. Well, we know there have been a couple of million hits. And actually these days, that's where most people get information from. They don't want a 45-minute phone call or a face-to-face appointment. They go on the internet. And if that site is being well used, that probably better than the raw statistics sound. Likewise, at the top end, if they just go straight to an advisor and never use PensionWise, they score as someone who didn't use PensionWise. So I guess it's the kind of people in the middle, as ever, who would benefit from advice, and we do need to drive up the use of advice, particularly as new options come on stream. And you know, I'm sure we'll talk about product innovation, but you know, it is very much a moving field and one where people need to keep up to date with what's on offer.
Okay, and one of the questions that we received was around sort of average pot size. I guess there's a generation of people that have had some exposure to DC, and again, average pot size of perhaps £17,000, I think, of what's been drawn down to this space. So how does that stand alongside what drawdown has traditionally been about?
But actually, I think that's a very healthy sign, actually, and that's the sort of figure that we've experienced at Royal London. People not trying to cash in £100,000 pots straight into cash and stick it in a bank account, that would be quite worrying. But very often these are not people's only pots, as you say. So the interesting question is, when we've moved through a world where lots of people have legacy DB rights to one where overwhelmingly people have DC pots, all I would say on, that'll be more the test, all I would say on that is actually that's going to be a while. It is staggering how long the DB, 5 million public sector workers are still accruing DB rights and 1 million plus private sector workers. Though many of these rights were accrued decades ago, so it'll be a long time before most people are mostly living on substantial DC pots.
Okay. You talked, thank you for that, you talking about the kind of approach to those DB pots as well, and perhaps in the last maybe 6 months we've seen increased levels of activity again in people operating over those pots in terms of transfer advice.
Yeah, I think so. I guess DB obviously is hugely valuable, and I don't think anyone would dispute that. But I think in two ways, there's perhaps a bit of a push and a pull going on. People see the kind of green grass of pension freedom, and they don't have that freedom in DB. So some people are looking over the fence and thinking that's a really nice place to be. And sometimes there's very, very good reasons for that. So restructuring benefits and things like that, more flexibility, it can be very good, and death benefits obviously, very good reasons for moving. The counter to that is a lot of cases it won't be. But and I guess the kind of push factor is transfer values compared to historic levels are actually quite high at the moment, and that's because gilt yield's been where they are. So we're seeing people getting quite attractive transfer values and being quite attracted to go where they go. So I don't think it's a huge surprise that more people are transferring. I guess the key is, from an advice point of view, is trying to make sure that there's good reasons always to go across. But I think when there is, it can be a very, very good piece of advice.
Yes. Aaron Webster, thank you very much for your question. Put to the panel, is there a risk that more British people will hesitate to invest in pensions and other investments until the Brexit is fully implemented, whenever that might be, and result in higher levels of contributions needed for retirement, i.e. the cost of delay? David, I'll give you this hot potato.
Of course, there's a risk. I mean, we really don't know what's going to unravel over the next months and years. My sense is this is where advice really comes into its own. Advisors can help point out to people the benefits of continuing to save, the benefits of still attracting tax relief on contributions, which are hugely valuable relative to almost any level of volatility over an extended period. So I can say no more than that. This is a proper debating topic, really.
Yeah. I guess, as you say, if you're talking about auto-enrolment for a start, you put your 4% in as a worker net of tax relief when it's all fully up and running, and it turns into 8% with the employer contribution and tax relief. So if your 400 become 800, even if it drops a few percent, it's still a blooming good way to use your money. So those fundamentals.
Are you buying cheap?
Well, quite.
So for younger people in particular, you could argue this is actually positive, because if you're investing at 25, investing at a lower level gives more opportunity for growth later. So the people at the younger ages are definitely not the ones to be concerned. For them, it's very much a keep calm and carry on message. So it's probably more people at or in retirement that might have more of an immediate issue.
And actually, of course, the fact they don't have to lock into an annuity this morning is crucially important, isn't it? Actually, the fact that they can potentially ride out the storm, phase things, see how things go, is a positive thing, rather than that kind of cliff edge we would have seen in the past.
So that might be like a blended approach. So should we talk perhaps about product innovations in this space and how perhaps what's happening at the moment might actually bring some of the qualities of those innovations to bear? I guess who wants to start first?
I guess I'm happy to go.
After you.
So I guess we've not seen huge amounts of product innovation since pension freedom came along. It's been relatively slow. I wouldn't blame providers for that. There was a massive amount of work to be done. And most providers were running very quickly to try and do what they'd absolutely needed to do. So product innovation was kind of the next thing on the agenda. So I'm sure that we will see a lot more coming out over the next couple of years. The ones that have kind of been launched so far, the main new category is a hybrid. So again, that's not necessarily dramatically new. That's taking two things that we already know and like, which is an annuity, which is people know, and a drawdown, and effectively just mashing them into one product. The beauty of that is it gives a lot more flexibility. So with an annuity's got fantastic attributes, but the one thing it didn't have was flexibility. So if your circumstances changed, your money keeps hitting your bank account and you're not able to do anything about that. But by putting it within a drawdown structure, a hybrid, it means that you can alter the annuity income, so you can drop it down if circumstances change and take it back up to its original level. So it does give a lot more flexibility and a lot better control over death benefits.
Yeah. And I guess from your perspective, you've again,
yeah, I mean,
changed.
it was picking up that in the opposite order. We've via our merger actually got the enhanced retirement account from Partnership, which is a very similar thing that Retirement Advantage have done. I'm slightly positioned on the earlier point there. I am not at all convinced that we need huge amounts of product development, and that's not a lazy marketing director can't be bothered to do anything in the difficult space. I actually think guaranteed income for life, guaranteed income for fixed term periods, together with the vast array of drawdown arrangements that are in the market, are probably enough for the vast majority of people. It's about configuring them. It's about being able to deliver them at an appropriate cost that the consumer is comfortable with, so that we can serve the various stratas of the market. I don't believe that the industry needs to do a huge amount of product development per se. It's much more about propositions and how we align advice with those propositions to get it to more people.
Yeah.
Just picking up, I guess I make two observations. I mean, one is later retirement. So it's fine setting people free at 55 to 60, but do we still want to be making active investment choices at 83? You know, we may think we can, but you know, is that a good social outcome? So I think what Pension Freedoms does is gets us to think about really long-term drawdown products, which might morph more into certainty and annuity-like behaviour, if not annuities, but something like that. So I think we will see more of that, and policymakers will expect it, because they'll just be a bit nervous about, you know, the great volatility at the end of life. But the other thing underlying the product is the investment approach. And something where we've put a lot of effort in, certainly in the last 12 months, has been diversification, multi-asset and so on. And we've been doing roadshows to advisors around the country, and I've heard my colleague Trevor Greetham talking about multi-asset and so on, with all these charts of different asset classes. And I was very struck with market turmoil over the weekend. Actually, not being in one country, not one asset class, starts to look like a pretty good place to be. You know, so it's not just about product; it's what underlies it.
Yeah, absolutely. Jonathan Lyons, thank you very much for your question. This is kind of about how do we get the qualities of advice to more people, and how perhaps a bit like the value of a guarantee. Lots of people want a guarantee, but how much do they want to pay for it? Well, lots of people would certainly benefit from advice, but yeah. So again, this is more of a workplace question. But why was there not, or could there be in the future, effectively advisor charging built into auto-enrolment pensions again, in order to, again, from Jonathan Lyons' experience, a large number of employees come up to the first annual review, but not that kind of the capacity to pay for advice. Clearly, I suspect, Jonathan, I don't know you, Jonathan, but I suspect you're not a charity. So again, thinking about sort of product innovation and getting people more supported on that journey through to at retirement, having access to advice that might help them make decisions at earlier points in their lives. What might the opportunity be there to build in a function that's going to support advice in the workplace? Questions for the floor, but I'm looking at you, Steve.
I noticed that. I guess one of the problems with all the charges that used to come out of people's pensions was, could you be absolutely sure that this was money that was benefiting the member? And so the big change was to say, right, if something comes out of your pension, it's got to be paying for something that directly benefits you, that you're not subsidising the employer or subsidising somebody else. Of course, the worry then is that, you know, advice costs which were just kind of absorbed and nobody ever kind of saw have become explicit. Now, that could be a good thing if employers, for example, expect quality, shop around and so on, but of course some employers just walk away, and that's the problem. I think the £500 a head that employers can now provide that much tax-free without being a benefit in kind is a step. Advisors say, I can't, £500 is nothing, but it's a start. I think and also allowing people to take 500 quid out of their DC pot for advice. It's all recognising that good quality advice costs. We've got to find different places to find that money. It's not going to be a one-size-fits-all. I mean, I was struck with the Financial Advice Market Review. For me, it was a bit of a disappointment. Lots of worthy thoughts and monitoring and initiatives and reviews, but there wasn't that sense of scale. I don't think the only thing I guess is as ever is technology, not as a replacement for advice, but actually to strip out the grunt work, the unnecessary costs, so that more advisors can provide the quality of advice at lower cost, and that's got to help, I think.
Yeah.
I think, can I just throw one more thing on that? I'm a firm believer that auto enrolment has got, obviously thousands, over 1 million employers will be on a journey where they recognise that they will not only need to but want to engage in helping their employees get access to advice. Now, this may take some time. I'm not suggesting this is a near-term change, but as employers get used to contributing to an employee's retirement welfare, they will also recognise it's in their interest to help them retire, particularly given the removal of the default retirement age. So if I know my workforce is ageing and really want to try and keep it moving, why would I not ensure that my elderly staff understand their options at retirement? What better way of doing that than pay for an advisor to come and see them? I mean, that's got to be the ultimate outcome of this, but as I say, that will take some time.
But certainly, Pharma and the budget reinforced that position, I think, reasonably strongly, didn't it? Certainly the research shows that once employees have had access to advice in the workplace, they expect some advice in the workplace based on pensions, then again, if the pension provider allows advisor charging for different formats, then again that can support the other half of the transition.
I think the one wider aspect is we probably all need to get better at quantifying the value of advice. So actually demonstrating if you take advice, it means in a particular situation you could be £100 a month better off or something like that. So actually giving quantifiable benefits for taking advice. So it's not just a cost; it's a cost with a very good benefit and outcome at the end of the day.
I think that with auto-enrolment, what we've seen is the ban on consultancy charging. So from a financial advisor's position, you can't take that commission anymore agreed with the employer for arranging these sorts of schemes. Now, whether you think that's a good thing or not, you can certainly understand why it's been imposed, simply because auto-enrolment is really an invitation. It's not something that when you first go into it as an employee, you really need to take advice from anyone. As the pot starts to build, you do have flexibility as a client and an advisor, because provided it's not within a master trust, and it's in a personal arrangement, if you are advising someone, then within those schemes you can actually take an advisor charge. So it's not been completely banned. So I mean, there's no commission, but you can put it through the advisor charging process. And I think that's because as a regulator, they recognise the value of advice.
This is started to encourage questions through. So thank you to Ian Clark. This is I'm going to try to ask three questions at the same time, and then we'll try and. So this is what's this a hybrid? I think it's a hybrid question. This. So the first thing is clearly, for those that have cashed out of pension funds, haven't necessarily, should we say, secured a guaranteed income for life, and are now running down their assets. Effectively, what happens when people run out of funds? So let's hold that thought there in terms of that sort of nightmare scenario. And again, things like insistent clients and so on, what kind of risks does that build in, both for consumers and advisors? Secondly, and thank you, David Bowers, I think I've pronounced that right. If interest rates do indeed fall further, i.e. to zero, what does that mean for gilt yields and asset allocation? So where is low risk? So we've got income, we've got what is and where is low risk. And again, then Chris Oliot is asking, again, the panel's opinion on achievable critical yield for those considering entering drawdown. So there you go, the three furies. You could take them in any order.
Shall I start off on running out of money?
Yep.
Because that was the Lamborghini scenario, wasn't it? That was the we'll all be irresponsible, we'll have nothing left, and we'll go and claim pension credit or something. And that hasn't happened overwhelmingly. Partly tax And it's worth, when we go to the lifetime ISA debate, just reflecting on the fact that tax does act as a brake on withdrawals and is stopping people going too fast. I also think personality is part of this. The sort of person who largely voluntarily has saved, sacrificed, scrimped through their working life, on the whole doesn't become the mad spendthrift at retirement. They're generally the more careful and so on. And ironically, the evidence, for example, from Australia is the opposite. It's not that people blow the lot too quickly, it's that on average they're too cautious. And the reason Australia are looking at more annuitisation is not because people are going mad, it's people are being too cautious and living on too low an income in Australia. And so trying to get this thing right now, I think it's much less of an issue for advised people, obviously. I think it's a big issue for unadvised. But for advised customers, what we've just set up is a dashboard for every advised customer that comes through Royal London, that the advisor can see a red, amber, green warning light, and linking to the question about critical yield. What was the plan? How long were they expecting to draw down for? How are they doing compared with their plan? So it can be constantly monitored. And that, I think, is real added value that an advisor can bring.
Well, that's helping them with the scale of having lots of people that are touching into this scenario in different ways.
Yeah.
How, from your perspective, then, in that kind of that hybrid of different terms, where's I'm going to give you an awful question again. Apologies for this, but where's low risk? Apart from being sat here, of course.
I've really no idea where things will go in that regard. Clearly, it's likely that interest rates will come down at some stage, or come down further. They have come down in the last 24 hours or whatever. Where they will go in the medium term, I think is anybody's guess. I'll probably defer to technical colleague or
Think visualising that potato.
I think the one thing I would say is drawdown has to be a kind of medium long-term arrangement. So people shouldn't be going to drawdown worrying about what's going to happen in 2 months' time or 3 months' time. And I think that's where advisors can really, really add value. So I think that the big worry that I would have is people in non-advised drawdown going in, taking an income out, the fund falls, and a year down the line you can be in a fairly horrible position. Stripping it all out at that point in time is not necessarily the right action to be taking. So I think that's really where advisors can add value about the whole. There might be things to do. There might be changes to investment strategy. There might be changes to income level being taken in the shorter term potentially, or again, is there a potential that you could take some income from an annuity while leaving the bigger bulk to grow within a drawdown. So I think there's a whole variety of strategies to try and calm the situation, but going back to the initial thing, I'm not sure we should just rip everything up that we've always known and start again, because if somebody's going into drawdown today, it should be with a view to being there for 5 to 10 years. Yeah,
absolutely. Ralph Dixon, thank you for your question. I'm going to hold it over until we talk a bit more about workplace pensions and perhaps talk about the secondary annuity market, because I guess again changes there a bit like final salary. Just your views really, firstly about how much activity you've seen and demand you've seen for that, and the kind of support that advisors are looking for.
Yeah, I think customers are definitely interested, so we're certainly experiencing calls from customers, and I would imagine our companies are. Advisors, I think, are interested but wary, and I guess certainly from my personal view, that's very much where I am. I do have significant concerns about the secondary annuity market. I can see why some people would want to do it, and some people may well get a good deal out of it. But I can see a good number of people losing out or getting a poor value deal out of it. So I think that would be my concern, is that we very much need to handhold people through the process. It's very difficult for someone to understand the value of an income stream being given up. It's very difficult for an actuary to work that out. So for a customer to understand kind of whether they're being offered fair value or not is a remarkably difficult concept. And so that's, again, advisors can help greatly in that situation, but that's certainly my concern is people could get quite poor deals potentially, and that could come off the back of, and we mentioned shopping around earlier, there could be a lack of shopping around and a poor deal in the first place, this doesn't solve that poor deal. This could effectively exacerbate that poor deal. So someone could get kicked again when they've been kicked once, effectively.
It's a curious fact, isn't it, that open market options have actually reduced as a proportion of individuals exercising those rights when they buy annuities. What do you think sits behind that? And again, does that pose some risks for the secondary annuity market?
I think it points fundamentally to the level of financial capability that we see in the population. And whilst people hear the messages around freedoms and so on that have been widely welcomed, as we've already said, I think it's quite clear that a certain part of the savings population don't engage with the processes that are put in front of them to make them aware of the value of things like shopping around and getting advice. And we need to keep working on that, exactly as the regulator had pointed out, I think 3 weeks before the freedoms, because that job's not yet done. And I think a similar issue may well arise with drawdown, where we need to make people aware that as they move from an accumulation phase with a respected accumulation provider, they may not be as well equipped to help them with the decumulation phase, and therefore making the saver aware that, again, that they should seek advice or at least guidance if it's a more modest amount of money, I think is going to be an important issue for the industry. Otherwise, we will see a repeat of what we saw with the annuity market.
And I guess one point I'd add, just to what David said, and I agree with all of that, is that we need to make it easier for people. So things like wake-up packs are still horrifically complicated, and that doesn't help shopping around, because if you get 42 bits of paper landing on your mat, the likelihood of many people picking it up and reading it is not great. So we need to, with the regulator, get something much simpler, something that will provoke people to take advice or shop around. And so there are some simple steps that we can do to help this.
Well, the dashboard, of course, is potentially one of those. And I'm actually personally a big fan of the concept. I'm less sceptical about its doability in the 21st century than some. But I think actually when a customer sees all of their, and this also talks to the earlier point as well about people running out of money from individual pots. With the exception of advisors, to be honest, very few people have a proper view of someone's entire retirement asset base. So I think the dashboard will go some way to helping with that, and also helping the customer see the real picture in front of them.
I think the decline in shopping around shouldn't surprise us. What's happened amongst unadvised customers is they've suddenly got all this choice. And what do we do when we're scared by choice? We stick with the familiar, don't we? So, I've got lots of products, even with my current provider, and then I can go outside and it's just, go away world, I'll stick with what I'm familiar with. And we do need to tackle that, and obviously more people using advice would help. On the secondary annuity, I guess, to be a sort of momentarily glass half full, the best possible time to introduce the secondary annuity market would be after a period of tumbling interest rates. If you've got a guaranteed annuity or something like that, it's worth a fortune today. We've just been talking about where on earth do you go for yield, and these products with what today would be undream of, So actually, the core value of these things actually looks pretty good. Clearly, we need to strip cost out of that whole process. One thing that worries me is the government didn't go for a sort of portal approach, whereby you sell your annuity through a portal, you get multiple bids, which is the best way of working out value and getting the best price. It's going to be a potentially one-to-one transaction, and that troubles me. I'm at home, I get a call from someone who says, I'll buy your annuity, give them my details, they give me an apparently attractive cash figure. All right, there's thresholds for advice and all the rest of it. Whereas if you had to go through the portal, maybe do your health check information once, so that's cheap and simple, and then you get multiple bids, I think you get a much better deal.
And I think there is a real risk of scamming in the secondary market, probably more heightened than anywhere else. Where we're, to your point about ageing customers, we're moving to a sort of more vulnerable stage of life. the point that you made, Andrew, around trading an annual income for a lump sum, no one can really work it out. I mean, I accept absolutely your point, Steve, but you have got declining health, you know, against you in that equation. But at the same time, if someone offers you £30,000 for an income that you've just goes into your bank account, you know, I'm afraid too many people may take it. That points to advice and or guidance, but also to shopping around. So if they are going to do it, they get the absolute best value.
Tell you what, Tom, it's interesting to hear all these issues and concerns about the secondary annuity market. Now, if you'd have bought an annuity, say, a couple of years ago, and you've seen everyone now being able to access their pension funds in a far more flexible way, you'd probably argue it's only fair that they have the same accessibility as well. But clearly, there's an awful lot of risk and danger with this, and this is why I believe this will not be an advice market. I wholeheartedly agree. I think if someone is looking to access their annuity, it is something they should seek advice over. I just don't know where it's going to come from. Because you look around, you speak to firms, they understand the risks, they understand the dangers. This is probably one of the biggest risks they'll have to their business, and I think they'll sidestep it, which is going to create an awful lot of consumer frustration because someone wants advice, they won't be able to access it. And this kind of really, I felt this when I read the latest regulatory paper talking about the annuity market. It spoke about the providers and the brokers, but it didn't really touch upon the advisors, because I think even the regulator realises as a risk this is probably far greater than most firms are willing to go.
I think you're right, and that feedback is mirrored by the advisors I've spoken to, which is that I can't see there being a huge flow of customers to my door, and therefore getting my head around doing this is going to be quite a tall order, and then I can only really see downside, i.e. that volume of fees isn't going to really warrant that. And I think where this may end up, which is where the open market annuity market was benefiting pre-freedoms, which was you get specialist firms that just do this in the same way that we saw lots of firms just broken annuities into the whole of market open market. So they were getting the customers the absolute right outcomes or best outcomes. And I think you'll see that here, where there'll be a handful of specialists, and most advisors will say, I recommend you go to X, Y, Z. Now, I'm not aware of any doing that yet, to be honest, but I suspect that's where we will end up.
I probably agree with that. But the real interesting point about that is we know now the regulator is carrying out a review of those firms because the information which is being provided to consumers about lack of awareness and lack of information. So it'll be interesting to see the outcomes of that before I think anyone steps into that particular marketplace.
Yeah, and I guess the other slight issue with secondary annuity market is the number of active buyers as well. So there is a potential that it could have a very, very small group of buyers, in which case consumers again potentially can lose out because of competition.
Of the market. Okay, so drop through any questions that you still have on the wonderful world of pensions freedoms. We might sort of start to step towards the workplace a bit. But talk about the lifetime ISA, because it has a tentative step towards the workplace, but certainly currently squarely in the world of the individual. So last time we ran this session, there was a lot of demand for, I guess, just a bit more explanation about some of the potential pitfalls around that as a wrapper, how it sits alongside the rest of the ISA family against individual pensions. So I guess just reflections really about how does this look as a tool now in a consumer's armoury? Okay.
I guess where I set on my view, I see it very much at the moment as an addition to the stable, so certainly not as a replacement for the pension, and I guess we'll have to see where the political moves take us, and that might be a different view, but to me it would be very much you do your pension, you get your employer contribution, and this might be an extra that you do alongside that. The one difference to that is self-employed, and self-employed, this could be a very attractive tool for self-employed people to use. The concern obviously being that younger people might opt out of the pension to use a lifetime ISA with a view to housing and things like that, so it could be very attractive on that basis. But giving up the employer contribution would be a big problem, so we need to try and make sure that behaviour hopefully doesn't happen as much as possible. And then I guess the other thing we need to see is just what these events are that you can take your money out for, and I think keeping it fairly tight would be my view. As you know, if we start saying you can take it out pretty much for any reason you want, then that takes away from it, takes away from its value. So I think we still need to have very specific events that you can access your funds.
I must admit, Adrian Bolden the other day was suggesting you take it out for a wedding, which is very interesting, you know. But lifetime ISA just seems to me like, can I say a horrible hybrid? You know, we already had an ISA for Help to Buy. You know, so if government thought it could help young people buy a house, question mark, does it just stoke up the housing market? But you know, maybe they want to stoke up the housing market now. But that's there already. And then you've got your workplace pension. And then you've got this funny thing where, I agree with Andrew, in theory it looks good for the self-employed, but most self-employed people are 50 plus, and you can't take one of these unless you're under 40. And so there's this kind of, and then at 50, the government top-up stops, and you can't touch it till you're 60. But it's not a pension, but it's not Help to Buy ISA. So what is it? And I just don't think the government knows what it is. We may see legislation on hold, because one of the things that people often miss about government is that legislative time, civil service time, lawyer time is a scarce resource. And if you've now got at the Treasury a bit of something else on your mind, something has to give. Maybe it's the lifetime ISA, maybe it's the secondary annuity market. We just don't know yet. But you know, lifetime ISA is already in the Queen's speech. They're in theory legislating during the course of this year. There's still consultations going on. It could be delayed. I think that's quite a realistic possibility. But I just think they need to decide what it is. And as Andrew says, the worry is, you know, we talked about young people not needing advice. Well, they don't with auto-enrolment, in the sense they should just go in, take the employer contribution. But if people always say to me, young people haven't got enough money to save, well, they sure as eggs haven't got money to save in 2 places. So if they make the wrong choice, and who's going to help and advise them about that? And what I think will happen with the lifetime ISA is overwhelmingly it will be parents and grandparents, particularly higher earners who maybe can't put 40,000, only put 10,000 into a pension. What do I do with the rest? I give it to my kids and my grandchildren. And I kind of think, you know, I've said with tongue slightly in cheek that every lifetime ISA will be opened by someone called Jocasta or Jeremy. You know, it's not the hard-pressed 20-year-old renting in squalid digs trying to save for a house. That's not who's going to open these things.
Is that what the J stands for? I always wondered that. So what kind of, I guess if you weren't going to pause it, but you're going to think about the other utility that kind of wrapper could be put to now, because again, there's rules based on when you take the money out. But what other opportunities might that or something like that give the pension savings landscape or the savings landscape in the UK?
I guess if you've maxed out on your workplace pension, your employer contribution and all of that, then actually the tax treatment of lifetime ISA is free money. You know, it's basic rate relief on the way in, no tax on the investment, tax-free on the way out. That is as close to free money as you get. So, you know, nobody would criticise someone who opened one. It looks pretty attractive, as long as you're willing to essentially to lock it up for till 60, and of course trust the next generation of politicians not to tax it at the end after all, which might be a big ask.
Should we talk about some of the other sort of trust when it comes to pensions, and talk about what potential risks there are to things like the triple lock that's been discussed, whether that's just abroad or even back in the UK. I guess when you have a massive change like this, what does it put back onto the table to be discussed? And again, welcome any thoughts.
Puts everything back on the table. So I mean, none of us know what's going to happen, but the likelihood is there might need to be some cost savings at some point. I don't think that's a huge leap to say that. So and then it comes down to what can you cut potentially. I think a triple lock, it's difficult. My view is it's probably safe for the next few years, but beyond that, it becomes more questionable, I guess. So also it comes down to political. So the current government is very keen to get support from pensioners, and there's always a political motivation to all of these things, I guess. So if it's a different government, they might have different motivations, so they might look to target that money in a slightly different place.
What about the prospect of, again, the lifetime ISA was supposed to be potentially the Trojan horse towards a TEE approach. Again, does that become more or less likely based on events?
It has to be less, but again, in terms of probability, I couldn't tell you whether that's gone from 1 in 2 to 1 in 4 to 1 in 20. Steve may have a better view.
But I guess the argument from the Treasury point of view for TE is you get your tax on today's pensioners and your tax on today's workers all in one. So if we're broke now, you could argue that something that suddenly brings your tax forward is potentially more likely. It's still a hell of a reform, though, isn't it? Sort of, And one of the things about changing pension tax relief, people often say, "Oh, tax-free lump sum." But if you honour what you've got to date, the amount you get by abolishing tax-free lump sums takes forever. It's not that big, it's 4 billion out of 40 billion or whatever it is, and you don't get it in one go. It takes a long time. So I think that the balance between the revenue and the politics on something like the tax-free lump sum don't look very good. The triple lock, I guess, if you think what happened last Thursday, it was that old people went out and voted and shaped the future of the nation. Just at that point, for a politician to come along and say, well, you're first in line for cuts, some of them may feel like it, but, it just doesn't seem to me the right target group. But, things like the lifetime ISA costs £500 million a year by the end of this Parliament in government top-ups and the higher ISA limit to 20,000. You could see them, things that haven't yet happened are presumably highest on the list for not happening if they cost money. That's the way I tend to think of it.
And I think going back to Steve's point about parliamentary time and things like that, the simplest ways of doing it are easily established. Money on income tax, the kind of sin taxes on cigarettes, alcohol. Those are very, very quick and easy to do and do raise substantial, some of them raise substantial amounts of money. So if you wanted to do something quick, doing something that's already established would be much easier.
Annual allowance 25,000, lifetime allowance $750,000. I mean, you can, it's just a number in the system, and we'd all go, oh my goodness. But if you're a broke chancellor and you can just, as you say, change a number,
that seems like the simplest.
Turnkey reform. Okay. Right, I'm going to move to quickly Sean Barry. You're talking about communication, talking about simplifying pension quotes and illustrations, and does the presentation. Perhaps we can slightly broaden that out. I guess if you think about all of the change, where do we have to? Where's most important to get communication right, so that we can get, as an advisor, you can not have to spend most of the time explaining what the paperwork means.
I think communication to me and across the piece needs to improve from 20 up to 80. I think, and part of that is us as an industry, and part of that is government. So we're both culpable to some degree. I would obviously argue a regulator doesn't help, doesn't create an easy situation to make things as readable as you would want to make them. So I think things like wake-up packs, we all know wake-up packs could probably, and the hope is, be on one sheet of paper to a large degree. From a regulatory perspective, that's impossible at the moment. So we could move down that road, and we could make things much, much simpler than we do, because I think we all, we'll probably all speak to people outside the world of pensions, hopefully. If you do, people are just confused by so much of what we do, and it's, it's perfectly reasonable that they are. So we all need to get better at communication, and illustrations is a great one. You can pick up an illustration and it doesn't mean a whole lot. A lot of the figures, there's a lot of figures on there, but a lot of the figures don't mean a whole lot, because the probably the only guarantee is none of those figures will turn out to be accurate.
Does that pose a challenge for hybrid propositions, where you're having to illustrate a number of different things at the same time?
I don't think any more than any other product, in that you using the same rules to project things, there's a likelihood of that turning out to be accurate is no more or less than any other quote, I guess.
I guess on good communications, one of the keys is timeliness. And one of the problems with wake-up packs is that they're too late. The evidence, some of the recent evidence on pension freedoms is people have decided what they want to do a good year out or more in many cases. So certainly by the time, we found people would ring us up and we'd say, we need to go and talk to the guidance service or advice. And they would say, I know what I want to do. Why are you stopping me getting my money? And so the whole point of the guidance and advice at that point was coming too late. So, whether it's wake-up packs at 50 or whatever it is, actually when we send the communications is crucial. And this whole concept of sending communications is a funny one, isn't it, really? Surely we're moving to a world where it's all on our phones, it's all we just need a completely different mindset, I think, and, it's a slow progress.
And I guess one of the big issues we've got as an industry is we're kind of putting people in, and completely understandably, but you're putting people in as a default at 22, and you're saying, don't worry about investment, we'll deal with it all, and then we expect them to get to 50, suddenly, magically, able to transact quite a complex set of calculations and things. So there does need to be a journey somewhere along there of gradually increasing the knowledge.
Sorry, just chip in. This sort of echoes my point about I'm not sure the issues that we have in our market are with products. They are with processes, communications, the whole environment which we push things to consumers needs overhauling. And I think when you talk to the FCA, they don't disagree with that, but they want you to bring ideas, proposals, suggestions to them, because I think we all know where we need to end up. And it can't take a decade. We need to get working on this whole customer engagement piece now.
In my previous role, I tried to have these conversations. So I said to my officials, okay, I was responsible for statutory money purchase illustrations. And I'd go to conferences and events and people would say, they're ridiculous, they're huge, nobody can make any sense of them. And I would say, come on guys, we need to fix this. And the answer generally came back that the actual stripped down statutory requirement was quite minimal. But it was all being gold-plated and everyone was being ultra-cautious, and there must be a better way. So it may not need a new law, but it certainly needs new practice, I think.
Some of the systems putting those communications out aren't 21st century systems, are they? So I think that's one of the challenges for the dashboard as well, I suspect.
I mean, I think the good thing about it now is, and it's on the points of engagement, we do need more engagement, but now people are having to make a positive election to their retirement decision, as opposed to being sort of influenced by that particular provider and the information that went out and their financial interest over their particular product range. It's now being given as information to a consumer to make them take a decision, which is a good thing. That's where you get the engagement from. So I think that's a really positive step.
Yeah.
Perhaps there's too much information for them, but it's a positive step.
This is worth waiting for, Ralph Dixon. Thank you very much for your question, because it ties then, I think, into this, which is there a kind of a quiet risk bubbling away, which is that there's the definition of qualifying earnings in bank qualifying earnings in the workplace that is not a concept well understood by even the practitioners around payroll and pensions, let alone that individual consumer. It's not 8%, or it is, but it's not 8% of what they expect. Is there a kind of a latent risk in this market of people that are going to find once again that they didn't get what they expected around financial services?
Yeah, I mean, so there's a 2017 review of auto-enrolment, and I'm sure whether the contributions are on a band of qualifying earnings or the whole of earnings, that will be one of them. I think Rosal was quite sympathetic to making it from the first pound, for example. There are issues of that if you suddenly go from a pound below 10,000 a year to a pound above, and suddenly there's this cliff edge of you can see that there's trade-offs here. But the fundamental point is absolutely right. Government has set the rate of the state pension, government set the 8% number and the bands and all the rest of it. Your average punter might assume that they've been set with a target in mind of a decent enough retirement, and guess what? It turns out for an average earner, you won't get one if that's all you do. And I think the 2017 auto-enrolment review overwhelmingly has to be about getting beyond 8%, whether it's of a band or of all earnings. It's got to be, how do we move beyond that? Making sure everyone gets a pay rise. When they get a pay rise, some of that goes into a pension, new defaults. We could look at all the minutiae of auto-enrolment in the review next year and miss the elephant in the room, which we just heard flagged.
Yeah, excellent.
I think a big issue with the band is just people with multiple jobs as well. So particularly women who might have 2-3 jobs, which in total gives them a substantial amount of income. They could end up not having any pension provision at all. So again, I think that's something that perhaps needs to be looked at.
If we think about the pushing back of contribution increases, that's from a provider perspective, that meant smaller amounts of assets under management for longer periods of time, and that's been a challenge. When you think about the over 70 master trusts that currently operate in the UK, what's your perspective on, again, whether there might be some challenges there in terms of consolidation, and again, what's the risk to somebody that's invested in a master trust rather than in a contract-based scheme?
I think overwhelmingly, we've got a small number of big master trusts that are well-run, well-governed, efficient, and all the rest of it. And then you've got this kind of very, very long tail of master trusts that will probably not end up being of sufficient scale. And that's really why we've got legislation in the Queen's Speech to just make sure that wherever you're enrolled, there's the minimum capital requirements, minimum governance standards, and so on. And the funny thing is, people sometimes said, well, why wasn't that done on day one? It's because everyone assumed at this end of the market there'd be nobody willing to provide, or, you know, it would be Nest, basically. And suddenly we've got this proliferation of master trust, perhaps thinking of other products they can sell, you know. So there does need to be better governance at that end. But overwhelmingly, you know, the pushing back of the increased contributions, like was only 6 months, the most recent one, and actually doing it in April when you step up rather than October, I think is a good thing, because if it coincides with a tax cut or a pay rise, you may not even notice it. So the crucial thing is we actually get there, we don't keep changing it, but we have a plan to go beyond, which has to start now. Because if we leave it to 2019, well, it's an election next year, perhaps, you know, and then we think about consulting and it's 2025, you know, we've got to get on with it.
Yeah. Okay. Any more questions from the audience? Much appreciated at this point. Looking down my list, apart from DC Code of Conduct, which we've all promised not to talk again. Put your questions in now, or you get DC Code of Conduct. Think about that. Just looking down my list. Well, I guess perhaps just dwell before we've got a few minutes before we wrap up. Just again thinking about maybe the kind of product innovations and the areas where you think, if you know, as an advisor trying to help and guide their clients through the short to medium term, what are those innovations that are really going to help?
Well, I think going back to the point made much earlier, the whole concept of blending, in my view, or in our view, is a very sensible thing to think. And I actually look in the rearview mirror pre-freedoms and still wonder why we weren't doing some of that as an industry pre then, because it was perfectly permitted. The notion of someone quite wealthy having a guaranteed lifetime income underpin seems a sensible thing to do. The notion of someone less wealthy having some flexibility as well as a guaranteed lifetime income seems to be the most sensible thing that we could all do. I take the point that it absolutely won't all be happening at age 63 or whatever the average was pre-freedoms. It may well be 68, maybe 72, as the whole retirement environment changes from a demographic, from an employment, from a multitude of perspectives. But I think that as a principle is where we'll end up as an industry.
I guess the other bit, quite big change from an annuity point of view was the change to death benefits. So that enabled longer guarantee periods and things like that were able to be put into the market. Took away one of the big negatives of annuities. So people generally, one of the big problems with annuities was I buy an annuity, I die after 2 years, the provider keeps all my money. And people absolutely didn't like that concept. So by putting on much greater death benefits, they can ensure that the family get benefits. So that takes away one of the big issues. And that's perhaps something that's not been talked about enough over the last year, is that you can now combine a guaranteed income stream and with good death benefits for you know, perhaps part of your pot.
And certainly that intergenerational perspective is, from an advice perspective, that's you know, a hugely important role that an advisor will play to help the other generations once, unfortunately, someone does die.
Yeah, and I think, you know, customers absolutely love that bit about pension freedom. So the whole passing money on to the next generation has definitely caught people's imagination. So they like that whole ability to do that. So absolutely, advisors are key in helping them do that in as most tax efficient a way as possible.
I was thinking, as you were talking about people having to make complex investment decisions come 83. The lasting power of attorney kind of aspect of this, I think again it really does draw. It's not just pensions, is it? Pensions is part of a much broader picture, and include other generations in that as well.
And I guess like, you know, long-term care type aspects, equity release, potentially releasing money from your home, and you know, so that, again, that's where an advisor can help, is pulling all of these strands together, because we talked about not just looking at one pension pot, you look at all your pension pot, but you need to think about a house, because the house could be a bigger asset than all of the pensions put together. So that obviously needs to play a key part in longer term financial planning, particularly things around long-term care.
And because the irony is, on the one hand, you've got a set of people who can release equity, and on the other hand, we're reading in the papers every day that you now get a mortgage till you're 85. So actually, I think a third of all the mortgages that went past the age of 65 went to first-time buyers. So it's just kind of, we're going to a completely different world where, as you say, end of default retirement age, women's state pension age rises. I'm 50, my state pension age will be at least 67. We're just barely beginning to think of the changes all of this is going to make, I think.
Yeah.
Wow.
And more people wanting to work into retirement,
Yeah.
or having to work
Yeah.
into retirement,
Yeah.
like that kind of later working.
Well, that's the breed of the 40-year mortgage, isn't it?
Yeah.
Okay, thank you very much for your time and your questions. Again, if this has prompted, apart from questions about whether it's robo-advice or robo-guidance, apologies to everybody for that. If this has prompted more questions, then again, clearly drop those through and we can pick those up and post them straight back to you. And again, you can re-watch this on the Advisor Hub. So thank you very much for your time, and again, thank you from the panel.
Thank you.
Thanks, Tom. Thanks, everyone.
Thank you.